Okay, 11:01. Let's get going. If there's a problem, somebody put in a message if you can't hear me or anything like that. So before I start, I've been learning a lot about training, learning, and teaching recently. And one of the problems you have to solve for when you're teaching is most teachers, they teach the way they learn something, right? And that's a big problem because guess what? Not everybody has the same learning style. So instead of reaching, everybody in the audience, you're actually only reaching 25%. Now, there are four learning styles. Okay. You have the why people. They always need to know, why am I learning this? So you have to spend time actually almost motivating, convincing them this is why you need to do this. You have the what people. The what people are like, who gives a shit about the why? I know about the why already. I know why I'm doing this. I just need to know what. Okay. Then you have the how people. And these are the people, usually the majority of people in the investment business, actually, they're the procedures. Give me a process. I need to know a procedure, a process, uh, uh, a checklist of doing things. And then you have the what if people. These people are like, look, I know the why, I know the what, I know the how, but if this shows up, what do I do then? So if ever I say something and you don't understand what the hell I'm talking about, you might just be a different learning style. So just ask the question. Okay. Um, and by the way, I'm thankful for my mentors for having taught me how to teach. Teaching and training is one of the most powerful things that you can do. And guys like Wyatt Woodsmall, Evan Pagan, Michael Mauboussin are people that are some of the best investment teachers. Peter Kaufman, of course, my God, perhaps the best business mentor alive. And people that know him are lucky to know him. Okay, so this morning, well, actually, let me give some context. So a few weeks ago, I sent out one of my investment memos, and a friend of mine sent it to a whole bunch of people without telling me. It's okay, it happens. And a guy reached out and said, "Hey, um, we're actually dealing with one of the problems you write about the memo. Can you do some consulting work with us to actually help us with this?" And I'm like, I don't do consulting. He's like, "Well, this is how much we pay." And I was like, "Oh, I do consulting." And um, amazing guy, by the way, very, very smart. Um, and one of the things that came up was training materials, right? Um, so, what training materials do you actually give to your team so that they can actually get better at investing and make your partners, themselves, and you a lot of money? That there's not enough time spent on curating and having a internal process where you actually invest the time with your team on training them. Andy Grove wrote an amazing book actually, he wrote two amazing books, excuse me. One of them is Only the Paranoid Survives, which everybody thinks about paranoia. It's actually not. It's about strategic inflection points, must read. And the second is High Output Management, which is basically on how to be a leader manager. And one of the things he says is that as a business owner, 1 hour spent training your people can have, if you improve them 1% across the organization, can have a massive return on time, right? And there's a few things about training materials today that you have to solve for. Um, One of them is young guys don't fucking read anymore. Okay, I don't know what the hell has happened to you guys, but you guys don't read. And And it's a shame. It's a real shame because there are $1 million mistakes in a $10 book, or sometimes a book that you get for free on the internet, that can either make you a fortune or prevent you from losing a fortune. So you have to actually spend the time reading. It's very important. The second thing is, a lot of the training materials were actually designed for pre-08 markets. So what does that mean? Is as well, the market actually changed after 2008. Before 2008, the market was a certain way. Post 2008, the market has changed in ways that a lot of people have not adapted to, because the training materials that they use were all pre-08 training materials, that it was suitable for the environment before 2008. Okay? Okay. The third problem, well, actually, hold on. Let me spend a little bit of time. So before 2008, um, quant funds were smaller, index funds were smaller, the pods were smaller. Post 2008, these are all materially bigger and more levered. Before 2008, the research at the investment banks were actually pretty good. And part of the reason is commission dollars were really big, so they could afford to pay these guys. Post 2008, there's some really good stuff, but it's actually gone down in terms of quality. If you're lucky enough to read Bernstein stuff, yes, phenomenal. Some of the guys at some of the other shops are also very, very good, but most of it is, it's not that good. Okay. Before 2008, the internet and social media were non-existent, or very, very small. Post 2008, it's ubiquitous. So you have these narratives that can start online and spread like wildfire. You actually have to adapt to that, right? So there are other differences, but understanding pre-08 markets and post-08 markets is very, very valuable, and your training material has to solve for that. Okay. And then the third thing is, um, a lot of people, they may use external things in their training materials, okay? But it's actually very useful as an investor to actually diagnose what your team needs and then pick external material that helps solve for that, or build it yourself, okay? But here's also why you need to have training materials. Um, so you actually see, when you're training your people, like who actually is improving with it, who actually is getting better over time, because you teach somebody something and then you watch how they evolve for the weeks or months after that, and have they actually taken what they've learned and the training materials and improved. So Jeff Bezos does this Bezos memo uh, reading process. And one of the sneaky advantages of that process is that, so the process is simple, okay? At the beginning of a meeting, everybody in the room reads a 5 to 6 page memo. They have half an hour to read it. And then they have a couple hours discussions about it. And you actually get to learn a lot, right? Because somebody spent the time to put into narrative, not a PowerPoint, because these guys don't like PowerPoints, and I agree with that. Actually, we're a memo culture. And you read the memo, you have a discussion with it. But the sneaky part about it as a leader is, weeks after your team has read the memo, you actually get to see who learned from it, and better yet, who changed their minds weeks later. So somebody will come to Jeff after and be like, "Hey, you remember that thing we were discussing? I changed my mind on that, and here's what I think now." And often it's a way better point of view after than what they had during the meeting. Well, guess what? That's the guy that you pick to lead your business unit because he's able to change his mind, right? So having a training process helps you with that. It helps you find the power zone of the analyst. Often it's in training, right? It's in practice that you see, wow, this kid is really good at shorts. He's really good at turnarounds. He's really good at growth stories. He's really good at bull bear battles. He's really, and you're like, he's actually really good. Or one kid, and I actually like guys like that a lot. He's like, he's not good at anything, but he's really good at helping others get better. I actually know an analyst like that who's terrible analyst, but he's really, really good at getting other people to be better. That's very valuable. Okay. Uh, okay. And by the way, while you're doing the training, that's actually um, where you also see who the teachers and the leaders of your team are. Because if there's one guy he's not getting it, who's the guy that's actually going to go to him afterwards and help him get it? Okay. Training process that you have to do with the young guys today. Okay. Just same as the Bezos memo writing process. If you give, let's say, a 5-page memo, everybody sits in the room for 30 minutes, they read it, and then have a discussion. Why do you actually have them read it in the room? Because the young guys today are all these ADD freaks, including this guy, by the way, because I'm talking a big game right now, but I have fucking ADD, just like you young guys do. And you wouldn't believe the shit I have to do to get myself to focus. Okay? So you have them do it, and then you have a discussion about it. Okay? Actually, we actually have changed our minds about having interns do any work. If we have interns today, all we have them do is read because they're never going to get another chance to actually do the kind of reading that you do because today there's too much stuff stealing your attention. Okay, but let's say, so that's the process. And then you observe over time. Okay, if you're doing it by yourself, I really suggest you use these guys, earplugs. Okay, take your phone, preferably in the morning, put it away, put earplugs on, a timer for an hour, 90 minutes. Even if you do 25 minutes, read the memo. Okay. Now, after you've read the memo, it's very important that you adapt it to today's markets. Okay. It says, what about this that I'm reading is applicable to today's market? Usually, if you're reading something that is evergreen, it's always going to be applicable to today's market. Um, uh, the second thing is, what can I use in this that makes me a better investor? And the way that you do that is if you learn something, let's say from a memo, how can you take that and turn it into a checklist and a procedure? Always, always use checklists. Um, we're huge fans of it. You know, we have them here. Most investors, personality-wise, are called structural creatives. They're not artists that can create from a blank canvas. They're actually people that create within a structure of achievement, like a checklist. It's like while you're reading a question that you get creative and then you go and it draws out your creativity. So always use checklists. And then next is how can you have a differentiated insight about what you just read? Okay. All right. So, by the way, you could write a whole memo on this, but now let me give you the what. Okay. What should you read? Here are a few pieces. Anything by Michael Moses. Read it all. Literally. If I were you, I would spend the next 90 days, every day you wake up, you read one of his 5 to 6 page memos. They're online, they're free. I still can't believe that kind of stuff is free out there, which is unbelievable. Read it. take notes, internalize it. Often at the end, he has these notations. If you're really interested in a topic, dig in. Two, um, anything by Warren and Charlie, of course. Three, there's a piece by Zeckhauser called Investing in the Unknown and Unknowable. Must read. Uh, Charlie Ellis wrote a piece called The Loser's Game. Must read. Okay. In fact, if you read The Loser's Game, there's very, I don't want to like give the punchline, but there's an insight in there that it's such a simple insight that if you actually think about how to incorporate that insight, it can actually improve your competitive advantage. Okay. Okay. So that's about training materials. If you have any more questions on that, please ask, and then I'll pick that up in a little bit. Okay. I want to talk about hiring. Um, Now, it's unbelievable to me. I spent a lot of time at certain business schools, not only for learning, but for recruiting. And it's just like, it's a great hub of talent and knowledge. So, and I've spoken at a bunch. You can find that stuff online. And there's no classes on hiring at business schools. Isn't that incredible? It's literally one of the best investment skills ever, but yet no one really teaches. And I was at a family office I used to work for, an investor in Tiger Tech, it was called at the time. And I asked Chase Coleman, a young Chase Coleman, I said, hey, how do you allocate your time? And he said, I spend 50% of my time on hiring. Okay. And at the time, it was such an insightful uh, statement, especially coming from a very young investor. It was qualitatively excellent. And if you think about it, the secret sauce of an investment team is the talent. Stepping back a second, the dynamic range between an average analyst and really, really good analysts isn't 2x. I've stolen this analogy from, is it an analogy, an allegory? You know what I mean. From Steve Jobs, he says, look, the average cab driver and the best cab driver in the world, maybe you're 2x better. You get there 30% faster. He makes double the money. He's a great conversationalist, so he makes more tips, blah, blah, blah. The average software engineer and the best software engineers isn't 2x, it's 50x. The average investment analyst and the great investment analyst, it's actually close to 50x in some cases, if not 100x. And guess what? The drivers of dynamic range have nothing to do with IQ. Yeah, it helps to be smart, but you can lose a lot of money with a very smart analyst, okay? Like seriously, especially if they're very convincing. Holy shit, you can incinerate capital, okay? So what are the drivers of dynamic range? Very important to figure that out, okay? The second thing is hiring has 4 problems. It's expensive, it's time consuming, it's competitive, and it's reflexive. And actually, it's changed across pre-08 markets and post-08 markets. Today, a lot of the pods go and literally interview from undergrad. Now, we have a problem with hiring from undergrad. I think it's very rare that you have somebody. I'm in the process of interviewing somebody who's undergrad right now, who's very rare because despite not having a lot of reps, he's actually really good at handicapping businesses, but it's rare. We tend to want to hire from people that have seen reps. And part of the reason is our hiring tools are actually useful to picking up on the reps or not. Okay. So, so part of hiring is actually sourcing talent that, though is really good, isn't actually being sourced by other hedge fund guys out there. Because again, you remember the four problems. One of them is it's expensive to hire. Today, it's kind of nuts what somebody will pay an investment analyst. And by the way, when you add the resources, I mean, it's incredible. But in my opinion, those are actually perceived barriers to entry because the best analysts, all they need is a 10K and a fucking pencil. Seriously. Some of the best analysts I know, you give them a 10K and a pencil, that's it. They don't need anything else. Yahoo Finance to maybe check quotes, okay? But sit them in a room, couple hours, 10K and a pencil. And again, that's who I want you to be, okay? And I'll get to AI and to resources and all that stuff after. Um, okay, but I'll teach you guys one of the best hiring tools if you're a manager. And again, none of the stuff that I like to talk about is a pill. Okay, it's not like you take a pill and then it's a hack. No, it's a process. It takes work. The returns on that process are really big, but it's much better to give a procedure that you have to execute. It takes time because most people, even if they were like, wow, that's the best thing I've ever heard, almost no one's going to execute on it, and that's why you can share it because again, it boils down to the execution. And what it is if you're a good hire, if you're good at hiring, is the virtual bench. Okay, the virtual bench is a list of people, like you're an athletic team, instead of having a bench that you can call immediately and put them on the field if you're in the NFL, it's a list of people that don't work for you, that have been pre-vetted, that you've tracked over time, and when you are ready and you think they are ready, you hire them. It's a tool that helps you solve for the four problems. Hiring is expensive, it's time consuming, it's competitive, and it's excuse me. It's expensive, it's time consuming, it's competitive, and it's reflexive. Right? By solving these four, the virtual bench helps you solve these four problems because when you really need it, you're scrambling to hire somebody. The mistakes that you can make are actually very expensive. By the way, what I mean by reflexive is that a good hire can multiply your business and a bad hire can destroy your business way beyond the cost of what you paid him. The guys that came up with this virtual bench process are the Smart family, Bradford and Jeffrey Smart, and I think they say in one of their books that a hire can destroy value to the tune of 2 million of 20x the salary in some cases. I've seen that actually. I watched an analyst once lose $120 million for a PM in a year period. And the PM was like, well, he told me this, and I think he realized, he's like, well, thank God I only paid him 80 grand. I'm like, no, you paid him $120 million. Very, very different. Okay. So the virtual bench, here's how you do it. There's some people, they're just not ready to be hired. Okay. And what you do is you interview them, they go through your process, and then you put them on a list, and then you and your team, whoever's really good at hiring in your team, you track them over time. I recommend weekly. Some people do monthly, but it's like, how's he doing? Okay. What's he working on? Can we collaborate with him on an idea? What can we send him that will add value to him? Okay. And then you track him. Say, come bonus time, is it, how do you do last year? And then over time, once you've tracked that talent, you're actually able to be like, wow, he's gotten really good. And then you need him. It's like, okay, it's time to actually let's work together. Very, very important to have a virtual bench process. Okay. Another thing I would recommend about hiring, by the way, is if you take the way that we cracked hiring, because I was busting my head against a wall all the time, is we literally on a wall set up the hiring process and we put in every step of the process. So, for example, the request for proposal, the request for candidates, that's the first step. You get a resume, that's the second step. You reply back to the resume, that's the third step, on and on and on. And then we literally put in how do we do it? How do we know other teams do it? And then we started interviewing people and be like, hey, how do you hire? And we started placing it. And then we have a principle called the Astroteller principle, where we said, okay, if you're trying to make anything 10x better, you have to use differentiated tools, differentiated assumptions, and differentiated questions. And we started asking different questions like, hey, everybody does this step almost towards the end. What if we did it at the beginning? And then boom, we saw leverage. Okay. But one of the things that came up is that the hiring process doesn't end when you make an offer to the kid. It actually ends 3 months after you've made the offer. It's very important to actually understand that. And a lot of mistakes are made because of the assumption that the hiring ended when you made the kid the offer. So I would leave with that. Okay, third thing I would discuss, portfolio management. Okay, it amazes me still that there are no good books on portfolio management out there. Not that I want to write it. I have written extensively about it, mostly for internal. And my friends that have read it all think maybe you should publish this. No. I see the torture that my writer friends go through, even though I enjoy having written. I think writing is torture for me. And you wouldn't believe the stuff I have to get myself to do to write. Okay, but I'll make a few comments. Do you know that most PMs destroy value position sizing? Most PMs destroy value with exposure management. Most PMs destroy value with trading. Okay, they actually add more value stock selection wise. Okay, except when it comes to shorts. I would say that short selling, a lot of PMs destroy value on the short side. I think shorting is for boomers like me. We actually enjoy it, but also it takes time to become good at the short side, and you have to study it. But I would make a few comments. If most PMs destroy value position sizing and you're a rookie PM, equal weight all your positions. If you have, let's say, 20 positions, 5% each, do that to get your sea legs. Okay? Don't try to say, okay, here are my top 10, because most PMs don't actually know what drives stock prices. Okay, they usually use valuation and IRR based measure. That's fine, but there are other things that drive stock prices. So what are the inputs that you use to know when you should size up or average down or get out totally? And IRR isn't necessarily the best. It's good, don't get me wrong, but there are other things that you can use as inputs. The second thing is portfolio management is personality driven. The kind of portfolio management style that you use should be suited to your personality. When you actually see the guys that do factor neutral or beta neutral that are really good at it, it's like, wow, he actually has that personality that would be good at that. Some of it is also IQ, by the way, because I actually do believe you have to be a brainiac on the nerd patrol to be good at factor neutral and beta neutral. Um, but the model I would recommend that you read about is the Jones model. Um, and that's the model that A.W. Jones came up with. It was then perfected by Julian Robertson and a bunch of the Tiger Cubs and the Tiger Seeds. And everybody has their own style to it, but Lee Ainsley has written extensively about it. That should be part of your training materials. By the way, I recommend in your training materials to read the Maverick case. It's a very important case. You can get it for $11 at Harvard Business School in their case department. Um, okay, so the Jones model, basically says, and this is pre-08, you run 150 long, 100 short, 50 net, 250 gross with a long short ratio of 1.5. And a measure of hedging is your long short ratio. A lot of people think that if you run, let's say 150, that you're hedged because you have a 50 net, but you're actually not because you have a long short ratio of 2, right? So it's helpful. The other thing that I recommend on portfolio manage, oh, sorry, let me go and talk about the Jones model. Um, Even though you use leverage, the short selling takes down your market exposure. So if the market tanks, you're usually hedged, right? And what A.W. Jones used to say is that even though leverage is speculative, in this case, you're using it for conservative ends, right? The second thing about the Jones model is that it really amplifies stock picking. Because you're using leverage, if you're a bad stock picker, you're going to find out really quickly. Okay? So if you're a good stock picker, you should find out. The other thing about it is it generally behaves in bear markets much better because what happens is if you're really good at stock picking, as the market's going down, the fundamentals of your longs is better. So your longs are not going down as much as the market. Whereas if your stock picking on the short side is really good, your shorts are going down more than the market. So your long short spread is actually tight. And the Jones model also emphasizes certain aspects. So, for example, it captures really, really well business improvement. I think one of the geniuses of Julian Robertson, if you studied him, was the simplicity of his approach. He was long good companies and short bad companies. That's it. So, what would happen if a company was really, really a good company, but he wanted to short it? Okay, that's the barrier to do that should be really, really high, right? So he didn't say, I want to be long cheap companies, short expensive companies. If you're a rookie and you try that approach, good luck because you're going to be faced with what's called the beta mismatch. Because guess what? The beta is usually driven by your holders. The holders of a cheap company are very different than the holders of an expensive company, and they behave totally differently around events or during the day to day. And you can be beta mismatch, and your net exposure can and your gross exposure can really murder you. So you have to be very, very careful about that. The one thing I would recommend if you're going to be using the Jones model is not only to be long good companies and short bad companies, but you want to be long good companies that are getting better, actually improving, and you want to be short bad companies that are actually getting worse. Of course, it's better if the good companies are cheap and get dearer over time. Of course, it's better if the bad companies are expensive and getting cheaper over time. Of course. This is to prevent all the value guys from having aneurysms over what I'm saying. Okay. So we've touched upon three things: hiring, portfolio management, and training materials. I think um, you can go very deeply in these things. Remember that our approach to our content strategy is to actually share things that improve the setup of investing of an individual. Everybody's like, this is how you pick stocks. That's not useful. What is this way that you set up structures, conditions, a network around you that will actually make you a better investor? Okay. Hope that was helpful. Let's answer some questions. Okay. All right. Best books on selling conservative options, fund management. Um, okay. I don't recommend uh, anyone using options. Options can be very much the path to the poorhouse for the uninitiated, and even for people that are highly initiated. Okay, it takes experience. You have to study it, and when you're doing options, you're competing against Jeff Yass at Susquehanna. It's very bad for your self-esteem to compete against Jeff, because not only is he smarter than you, he's richer than you and better looking. Okay, you don't want to compete against guys like that. Okay, I recommend as part of your training materials to read the Jeff Yass chapter in Market Wizards and see what he says there. And you're like, that's the guy that if I buy or sell an option is literally out there picking me off. By the way, having said that, there are times when options get cheap. Okay, and the way to think about an option is not by using the Greeks, is think of them like a bookie would. What are the pot odds and what are the implied odds? Okay, you have to understand options, the history of them to be able to use them well. So I don't recommend using options. Okay, this is not something that you ever want to be like, yeah, you got to get along. No, 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 no. Learn how to pick stocks better. Then later on you can improve on the options. Okay, best books on fund management. The Market Wizards book, must read. Start with the originals, the Druckenmiller chapter, the Kovner chapter, the Steinhardt chapter, the Jeff Yass chapter. Reread them. Second, More Money Than God by Sebastian Mallaby. It's on the historical context of the hedge fund business. Sebastian spends years researching something. In fact, his research was so good that other fund managers were finding out that he was researching them. So they were reaching out to him to make sure that what he was going to write had their perspective. The end of the book, I recommend you read it on physical, and I recommend you read it on Kindle. I'm a nerd, okay? So I often have a physical copy of a book and a Kindle copy of a book. And the reason why you want to read it on Kindle is he has these notations. You press it, and it goes towards the end of the book, and he gives you context on the conversation that he was having. Very valuable. And in fact, a lot of the secret to competitive advantage in the investment business are in that book. Okay. Now, let me step back. Competitive advantage in the investment business is three things: analytical, informational, behavioral. Okay. So whenever you're reading anything and somebody says something, you're like, wait, if I did this, this would probably give me an edge. Is it analytical? Is it informational? Is it behavioral? And by behavioral, I don't mean by my behavior or your behavior. I mean by like, how do you exploit the behavioral, emotional, psychological incentive or like structural things that happen in marketplace that create bargains. Okay. A lot of competitive advantage is in More Money Than God. I also recommend you read Reminiscence of a Stock Operator and you reread it. Um, every book has a secret. Every book has a flaw. If I were you, I would read the annotated version of Reminiscence of a Stock Operator, where uh, there's a interview by Paul Tudor Jones in the book, where Paul actually talks about what he gets from that book. Every time I read it, I learn. But also in the annotation, it actually tells you, hey, here is what we think he was talking about. So you get a lot of historical context. So books on fund management are powerful if they give you historical context. Part of being a great analyst is always knowing the historical context of the field you're in, the historical context of a management team that you're analyzing, and the historical context of a business and the competitive landscape and ecosystem that it's in. You have to know that stuff. That's what I would start with. Okay. All right. Am I routinely using AI? And can you describe how? Good question. Let me show you guys something and let me know if you can see it, okay? You might be able to hear it too, and I'll be able to see if you can. All right. Watch this.
Yeah, I'm just putting you over. You're going a little fast and smooth zone, okay? It's 25 miles an hour, 135.
All right. So what did we just see? So police officers have a camera. It takes a video, takes recording, and at the end of the day, this AI program takes the video and the recording and actually writes a report on it. Now, this is already here for investment management. Um, and it's very, very important to not only learn how to use these tools, but to learn the strengths and the weaknesses of them. And stepping back a second, the dirty secret of AI is that it's been in the investment business already since the 90s. In fact, probably Renaissance Technologies was the first to use artificial intelligence in the investment business, probably along with D. Shaw, and then their ilk spread throughout the investment banks and so on. So, but also in the intelligence business, so CIA, Mossad, all that stuff, AI has been in there also probably since the late 1980s. Okay. Now, what's interesting about it though is that the original AI tool was actually designed to play backgammon, which is a game that I happen to love. And one of my mentors wrote a book that is somewhere called Learning from the Machine, where he was a professional backgammon player and went and played against Gerard Tesoro's TD Gammon at IBM. It was actually IBM that built it. Did I get that right? I think it's IBM. But anyways, and my mentor was amazed because the machine actually had huge advantages. But guess what? TD Gammon, somebody came out with something better called jellyfish, then something even better called snowy, then something even better called XG. And as of now, I believe XG hasn't been dethroned. You can literally get it for your phone. But to watch what AI did to backgammon, and in many ways it wrecked the game because a lot of the romantic guys in backgammon that thought it was some mystical game, that it was like luck and feeling and intuition, and we throw the dice very softly, we throw the dice very hard. A lot of those guys realize, wow, I'm actually a fucking idiot. This is actually a game of skill. Okay. And then it did something to chess AI. Then it did something to poker. Then it did something to Go. And now it's doing something to investing. And guess what? The same mistakes that people made using AI for all these different fields, they're making them with the investment business and AI too. Okay. So it's important to actually understand that. If you guys are trying to understand what's going to happen with AI and investing, you have to read Tyler Cowen's Averages Over. I mean, I recommend you read the whole thing, but read, I believe, chapter 5. It's called Our Freestyle Future, where he discusses the insights that you can get from freestyle chess, where it's a chess tournament where there are human only teams, machine only teams, and machine and human teams, and who has the advantages. Okay, very important that you do that. In terms of speaking about how we use it, a lot of that stuff is proprietary. Um, um, uh, that's we could only share that with partners. But something that I think could add value, um, if you're younger, train yourself how to do analog first before you use the AI tools. Because using the AI tools take away a lot of the powers of a really good analyst. Excuse me. A really good analyst usually can read something and then he makes leaps of judgment and logic, and he also can read between the lines. He also can visualize a business just by thinking about it. And he usually has very, very sick recall, where he's like, that reminds me of when I read this. I believe that these AI tools take away a lot of that. Okay. And I'll share with you an anecdote. Um, the other day, a friend of mine sends me a 40-page report. And that's usually what his firm does, by the way. These amazing reports, like reading them is like sex. This time, I didn't have time to read it. And I've been testing ODR, OpenAI Deep Research. And I put in the report in ODR and it gave me 12 points. My buddy calls me. We end up having an amazing 30, 40-minute powwow on the idea. We dialed it up, okay? Meaning we found the field research plan. We figured out the qualitative aspects. We found the bull bear points. And then we kind of already had a plan and a workflow of what to do to really jack up the idea and figure it out. I don't tell him that I put in ODR though. But hold on. He's like, hey, by the way, that report you read, I use ODR to write it. I'm like, Mikey, what do you mean? It's like, say, well, I gave ODR all our reports and I told it, here's a ticker, write me a report according to this. And they went and did it. Like, Michael, hold on. You use ODR to write this. I use ODR to read this. Who's doing the work? And now take that interaction and multiply it. There's going to be a lot of mistakes made because dudes are not doing the work properly, okay? There's a lot of value and slowness and sitting there with a 10K thinking about things. Very important. Anyways, I hope that's helpful. All right. Have you seen transitions from tech into PE? What have you found, seen, or common patterns there, especially for mid-career professionals? I've seen a lot of it. You can have a lot of advantages, especially if you know the tech. Most PE guys don't know the tech. It's actually hilarious to actually see the PE guys. They're really good at, modeling, but they don't really understand the technology. You not only need to understand the technology, but understand the customer. Is the tech actually solving the pain points of the customer? The beauty of technology is that it lowers your costs and extends your reach, right? So understanding the tech and that's something that you can bring in, and you look at a business and you're like, okay, this is a product that can actually work. And then once you understand the tech, you can also understand the cost structure around it and where to yank out costs to make the business more valuable, and so on. I mean, there are other advantages. The problems you're going to have as a PE guy is, how do you solve the sourcing problem? Sourcing has gotten very, very competitive. And a lot of PE is a project management problem rather than an investment problem. One of my problems with PE is that you can do a lot of work and never close a deal. That always bothers me, actually. There are aspects of PE that I love. You learn a lot. You have access to internal documents. You get to control the incentives of management. You can put governance structures and rituals and that drive culture, things that we can't do on the public side. But yeah, there are ways. It's just worth studying. uh, Simon, we don't critique individual names, only because we don't discuss individual names. But I see some fairly high quality businesses on your list. I really, really recommend people study Nubank. It's not an investment recommendation. We're not in the investment recommendation business. It's a terrible business to be in. We're in the fund management business, and all of the businesses that you've listed are worth a study, and some of them are actually it's a very high quality that you put up. Um, there's a book on Amazon called Working Backwards, must read. Chapter 2 and Working Backwards on hiring. It's like sex for hiring. Um, Sorry, I can't be more helpful there. Any views on Fannie and Freddie released from conservatorship? Thoughts and recent opinion of Ackman, Pulte, Besant. Love Ackman, love Pulte, love Besant. There is no way in hell I will ever give you an opinion on conservatorship of Fannie and Freddie. It's not what we do. We don't give opinions. Are you a member of the VIC? Do you have any tips on what the committee prioritizes or looks for specifically? I've tried 3 times so far, but haven't cracked the code yet. You just need good ideas, Alex. Just work on your ideas. You have to read the best Vic ideas. I'm a Vic nut. I love reading Vic. But I'm also a memo reader. Every day I try to read 1 to 2 investment memos. Um, and I think I've written about this, and it's important. You need a daily ritual where for 90 minutes you're feeding your competitive advantage. So I have specific competitive edges at what I do, where not only am I good at it, but I try to get better at it over time. And I have, thank God. Because you should have seen me when I started out. It wasn't a catastrophe, but my Jesus. Sometimes I look back at the shit I was doing, and I'm like, oh my God, I'd fire me. And thank you to all my mentors and people that believed in me for giving me capital. Okay, thank you. But what is your process? Here's mine. I read three hedge fund letters. I read 110K. I go through the 13F of a fund manager that I admire, and I read 1 to 2 investment memos every day for 90 minutes. It feeds my competitive advantages. What's your edge? What do you gravitate to in investing? How can you feed that on a daily basis? I definitely recommend you read Vic. I mean, by the way, so to crack Vic, you kind of need to know who founded Vic and to be like, I mean, for example, the founders of Vic wrote a book called You Can Be a Stock Market Genius. Are you pitching ideas on Vic that fit that style? It doesn't have to be spin-offs, by the way, but are you? Very valuable to actually go and just read that book. Okay. The other thing is, are you pitching the heat? You know, are you pitching really, really high quality ideas? Are your ideas getting better? You know, we have a thing called idea discipline. If we read a memo and the memo is really good, we spend time on that idea. We got that from Barry Diller, who used to pick movies on the script. He called it script discipline. If the script is really good, you do it. But anyways, all right. I only have 15 more minutes. Okay. Do you incorporate tail risk hedging into your portfolio? Not really. There are times when maybe options might be really, really cheap and we buy some, but again, no. That's what our net exposure is actually for. Most tail risk, I mean, it's rare. We have done it, but it's rare. It's rare. You know, that's why we have shorts. If you're worried about tail risk, you should run with cash because you don't know, but the cash is actually going to be like your margin of safety in your portfolio. One thing, by the way, we're writing a memo right now on families and individuals that are able to keep wealth across generations. It's really weird because the people that have written on it miss all sorts of stuff because mostly they are not that family. They're observing the family. But one of the things which is really clear is that it's having cash when the market freaks out that really matters, right? Not really investment acumen. Is literally having not only the financial fortitude, meaning you have cash when everybody is being fearful and you're looking at everything and you're like, look, I don't know what it's worth, but it's 4 times earnings and this thing's going to be around in 10 years. So, you know, maybe it'll go down to 20%, but it doesn't matter because I have cash and I can buy it, right? So always having cash, always doing things to generate more cash, and having cash is actually the strength. You know, I put out a tweet on Buffett. His operating companies give him the cash to buy more when the market freaks out. Most fund managers don't have that. When the market freaks out, very, very few people are investing more money in their funds, right? Hypothetical, an undergrad has a free summer ahead. What should his daily schedule look like for those 90 days to become a good analyst? Read. And John Rui, in your case, spend time with me, pal. You made a comment before that generalists tend to perform better than specialists. Could you expand on that? Yes. So the specialists tend to know a lot of details about their space, which are important, but they tend to be really bad at the really good business stuff. Moats, right? Competitive strategy, bargaining power, you know, having cross-asset insights, understanding the customer. When you speak to a specialist, he sometimes likes to show you how smart he is because he knows words you don't. And you're like, what does that mean? And he tells you, and you're like, okay, yeah. There are certain sectors I definitely don't recommend generalists. A buddy of mine, he calls a certain sector where generalists go to die, and it's hilarious because a few people are experiencing that right now. Um, so the other thing is, a specialist, when his sector becomes overvalued, there's nothing for him to do. So he's constantly pitching you ideas. He's like, oh, it's not that valuable. It's not that cheap. But you as a PM, you actually have to know that his sector is overvalued and actually under allocate to that. We prefer generalists. Generalists also have cross asset networks rather than specialists that have, a network only within their space. Okay. So we know a few people, for example, that have only focused on financials and they have a hard time going to do anything else because they don't have the historical context of having done other things. And then the other part about being a sector specialist, it hasn't escaped the pods that it's easier to manage the sector specialist guys and replace them than to replace the generalist guys, right? And also to motivate and manage generalist guys, so if you look at the guys that run the center books and side pods, they tend to be more generalist. You've seen more patterns and you can recognize threats and opportunities better. I should probably write something about that because I don't think I just explained that correctly. Okay, only 10 more minutes. All right, good question. What are the most creative approaches to driving dynamic range that you've seen analysts take up on their own initiative? Your network. Expand your network. Find mentors. We're human chimpanzees, okay, which means monkey see, monkey do. Much better to have a lot of smart monkeys about you and then you imitate them. Very important to expand your network. Remember, the currency of our business is ideas. You have a great idea, call the smartest PM you know, pitch it to him, get his reaction. Okay? Over time, you'll get better. And over time, if you're pitching him the heat, he'll call you and pitch you the heat, right? Case study on Vanguard, some interesting narrative on that issue. Great point, Thicker. I like it. Thank you. You always need good shorts. Okay. One thing about um, great short selling is short bad businesses. If it's a good business, don't short it. Okay. I've saved a lot of money in my career where I look at something, I'm like, it's a really good business, but it's overvalued. I'm gonna go short it. Just don't do that. Find already a shitty business that got pumped up for some reason, and you're like, wow, that's not a really good business. Apply traditional competitive strategy analysis to it. Okay, bargaining power. We like breached moats. So if a business has a moat, and you can literally see the competitors like hitting the moat and breaching through, short that. So should one look at traits such as aggression or passivity when picking portfolio management styles? Absolutely. It's helpful here to study the poker terminology on this. Uh, the tight aggressive investor tends to outperform, I think. The loose aggressive guys, it's rare. I do know some loose aggressive guys that are really, really good. But what they do is they use crawl, walk, run. So they're tight aggressive when they're crawling, meaning crawling to being up 7%. Then they loosen up a little bit when they go from being up 7% to up 15%. And then when they're up 25%, it's like, holy shit, they loosen up. I don't recommend that. I'm a tight aggressive guy, even when I played poker. There were times when I was younger where I was the lag, but I was under specific poker playing situations. In investing, you're managing other people's money. Be tight. Be tight. Um, an analyst's job is to give his portfolio manager conviction. Nero, always great questions. Does this relationship also apply to portfolio manager and the conviction with his portfolio management style? Absolutely. Um, uh, Conviction is paramount. You have to be able to develop it very fast, and also to lose it very fast when things change. Very important to study Stan Druckenmiller on that. Uh, the at the level at which he changes his mind. It's okay to change your mind, okay? One of the reasons why we don't recommend people pitching their ideas publicly is the psychological aspects of having your word out there and being wrong makes it much harder for you to change your mind because you're afraid of people being like, you were wrong. So guys end up, who cares? You pitched it publicly, you were wrong. I was wrong yesterday. Okay, there's one idea that's a very popular short right now. We looked at it. We actually think it's a long, and it's being literally attacked like you wouldn't believe, and even by friends of ours. And we look at it, and we actually don't know. We've done the work. We don't know if it's a long. We don't know if it's a short. We have no idea. Okay, am I right? Am I wrong on it? I don't know. I don't know, but we love it because we love bull bear battles. And we haven't developed conviction on it yet, but we'll see. Okay. You spend time reading investment memos and company specific notes. If so, which are your top shops you trust the most? We can't disclose that. And I don't think my friends would like us to disclose that either. Um, there are some historical stuff out there. You must read anything Ackman puts out in the company. The level of work that he does, you know, it's very, very good. If there are guys out there that have put out things publicly, they're worth reading. Um, I can't think of people. Baron Capital puts out public stuff. We like to read their stuff. We think it's very, very good. Any mutual fund or outfit out there that puts out stuff publicly, read it and over time decide, if you've learned from it. By the way, one of the signs that you're reading a good memo is, are you learning from the memo? Is the hair on the back of your neck like it gives you the chills? For us, it's one of the signs that we know we're going to make money is if we're learning. Okay. All right. I only have 5 minutes. Ocean, I can't answer if we are long anything. Thanks for doing this. Have you considered writing a booking? Do you often write to clarify your own thinking? Any advice to finding a mentor? Find smart people, ask them questions, learn from them. Anybody that will spend time with you, your failure will be high, but you'll do well. Been diligently collecting your various content recommendations across your videos. Do you have a comprehensive list anywhere? Not really. I haven't done. Structured analytical techniques from CIA trainings. Them also must read. Yes, must read. Same writers. Generally to learn analysis, it's helpful to learn it from different fields. It ends up that every single intelligence outfit out there, including the CIA, including DGSE, and all the others, except for the Chinese, really, they've all written stuff about analysis. Go read it. If it's being used by governments and deciding life or death, read it. Rand Corp has a bunch of amazing pieces, especially on strategy. If you're trying to learn strategy in business, it's not just useful to read Michael Porter's Competitive Strategy or the Economics of Competitive Strategy or the Seven Powers or these books. But how does the military do strategy? How do basketball teams do strategy? How does the NFL do strategy? You need those analogies, very powerful. Met with a PM on 2 separate occasions. What would like to work for? How would you go about keeping in touch with his intent in mind? Okay. So this is gonna be the last question I answer. There's some really good questions here, boys. Geez, I could, but I have to go to a meeting with the co-C where the co-CEO of Netflix is speaking, so I only have 4 minutes. Hold on, let me see if this is the best question to answer. Notice everyone would like to work for. Who would you go back keeping in touch with his internet? Zach, ping me after, pal. You and I know each other. Ping me and we'll talk about that. Okay, Lucas, do you pay for any research content? And what's your weekly reading content routine look like? I read, like I said, for 90 minutes every day. There are sometimes weeks if I'm doing a learning project. So I'm doing a learning project right now on movie directors. Christopher Nolan is a god, and you can learn a lot from that guy. So I'm reading a lot about that, but reading 90 minutes. We have uh, a rule. We don't pay for research. We don't. Um, it's not. I don't want my guys to be paying for something that they can get for free. Okay. And part of it comes from how I started. I had no resources, but that makes me creative and it makes me reach out to my network. Okay. And in reaching out to your network, strategic benefits and strategic products come from that, where somebody's like, hey, you're looking at that. You should look at this, and that. And this and this and that ends up being the reason why you make money afterwards. So one of the constraints that we put on our guys is we don't use research. So we don't pay for anything. I can't, I use my tech stack that I pay for is BAMSec. Ticker, it was started by a friend of mine and I love it. And the cost benefit is just insane. And FinViz, I have a Bloomberg. I pay for it. I very rarely use it. Uh, Go figure. Okay. Generally, I'll cover that question when you and I have our weekly session. Okay, what level of shamelessness is needed to build a great network? Do you have any examples of how you found your network and mentors? Last question. You need a lot of shamelessness. You're going to get rejected a lot. Okay? Hounding somebody is often a really good approach. Don't forget that um, people that have gotten to be very, very successful usually have done it with persistence and determination. In the old days, you guys are sending out resumes right now, 30 emails at a time. But back in the day, you had to print out 100 resumes, mail them, show up there, interview, and that level of persistence is kind of lacking today, and it's a game of numbers, so you have to keep persisting. The second thing is you have to follow the Professor Rao approach. There's a guy, Professor Rao at Columbia. He has an approach. He says, look, if you're approaching a mentor, you write him a message. It has three things in it. First thing, this is what I admire about you. Flattery goes a long way. Okay. Second paragraph, this is what I can do for you. Third paragraph, this is what you can do for me. And then you always make the third paragraph smaller, meaning your ask is smaller than what you can do for him. Always approach a mentorship with, how do I add value to this guy? Okay. You wouldn't believe sometimes by talking to a mentor and you're like, look, what are your fears and frustrations? What are your wants and aspirations? And you go and do research on how to solve that problem. And you call them back and you say, hey, I met a guy that can actually help you solve that problem. Okay. You have to add value. People think too much in terms of extracting value. That's not valuable. Add value, add value, add value. Much, much more valuable. Okay. All right. I hope that was useful. Differentiating management team. These are all great questions, guys. I could spend hours on that, but I got to run. Thanks for showing up. I'll try to put this up on YouTube later. I hope it was valuable. I'll try to do these more often. I'm an extrovert, so I often need to do this stuff. And again, great questions today. There's a bunch of guys here I know, but Lucas, all you guys, great question. Okay. Uh, JS, most important lesson I've learned this year, dude. So many. I could do a whole pod about this, a whole AMA about this. So we'll do it again another time. Thanks for showing up. I got to run.